receivable over net credit sales times 365. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, ending accounts receivable over net credit sales times 365. Days sales outstanding, ending accounts receivable over net credit sales times 365. Days sales outstanding, 365 over accounts receivable turnover. Days sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding. Days sales outstanding, average. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, average accounts receivable over net credit sales times 365. Days sales outstanding, ending accounts receivable over net credit sales times 365. Days sales outstanding, ending accounts receivable over net credit sales times 365. Days sales outstanding, 365 over accounts receivable turnover. Days sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365.
Welcome again. Time to work. We'll get started in a minute. All right, so let's go to our first question. Father God, thank you for this beautiful day. Again, we're here to continue our study. We ask you, Lord, that you give us wisdom, understanding, knowledge, and intelligence. Forgive our sins. Help us to understand difficult ideas and be able to explain them in an easy way for everyone to understand. Give us mental capacity to understand difficult things, Lord. Forgive our sins, we pray in Jesus' name. Amen. Okay. We continue with cash and cash equivalents. The company's monthly bank statement shows a balance of $37,500. Reconciliation of the statement with company books reveals the following information. Bank service charge, $25. Insufficient funds check, $550. Outstanding checks, $3,000. Deposits in transit, $2,750. Bank error included extra deposit, $200. Check deposited by the company and cleared by the bank for $527, but improperly recorded by the company as $572. The question: what is the net cash balance after the reconciliation? They are asking us for a net cash balance, but the question started with monthly bank statement. We really need to pay attention what we start with. Are we starting with the cash or with the books, or are we starting with the bank statement? If we are able to reconcile the bank statement, even if they are asking for cash balance, if there is no extra thing to do in the books, the same amount you find for bank statement is the same amount you will find for the books, which makes sense because you are reconciling. So that's why even if they ask for cash balance, if you want to start with the bank statement and you reconcile the bank statement, you don't need to go and reconcile the book again. Okay. So the bank statement shows the balance of $37,500. So I'm working with the bank statement, not with the book or with the books. Bank service charge, $25. When there is a bank service charge, the bank already knows there is a charge, so the bank has already reported the service charge. If I was reconciling the books, I would make the adjustment in the books. But since I am reconciling the bank statement, even if this is not what they asked me to do. Okay. So $25, this is already reported in the bank statement. Insufficient funds check, $550. Insufficient funds check. The bank already knows that too, because the client deposited the check. I thought the money came in. I recorded it in the book, but the bank says the money didn't come. So the bank made the adjustment automatically. Outstanding checks. When there is an outstanding check, that means I wrote the check to a client. I sent the check to the client, but the bank, my bank, has not deducted that money from my bank account yet. So that $3,000, even though it is recorded in my books, it is not yet recorded in my bank statement. So what I have to do is subtract that from the bank statement. Subtract this from the bank statement. So here I have $37,500 minus what? 3,000. Okay. 34,500. I have deposits in transit. What is deposits in transit? Deposit in transit is when I made a deposit. I recorded that deposit in my books, but the bank has not received the deposit, or it's not showing yet in my bank statement. You know, sometimes you make a deposit today, the bank says that the deposit is going to be available in 5 days. You made the deposit, you recorded that deposit in your books, but it's not yet showing in your bank, but you know that money's coming. So that's why I will add to the bank statement that deposit. It is $2,750. Okay. So $37,250. There is a bank error. Included extra deposit of $200. If there is a bank error, extra deposit, so that means the money I was not supposed to receive, it included extra deposit. That's money I was not supposed to receive. The bank made the extra deposit, but the bank will no. So this needs to be adjusted. Minus $200. There is something else. The check deposited by the company and cleared by the bank for $527, but improperly recorded by the company as $572. So in this case, there is nothing I have to do because the bank already recognized the right amount. So you don't need to adjust the bank in this case. And the amount that I have here is $37,050. Reconciliation for the bank statement. And this is what I will choose. If you reconcile the bank statement, you have already reconciled the books. $37,050, and that's correct. Okay, start. The company had the following accounts and balances in its general ledger as of December 31st. Petty cash, $500. XYZ Bank checking account, $20,000. Marketable equity security, $10,000. Marketable debt security, $7,500. ABC Bank depository account, $5,000. What amount should the company report as cash and cash equivalents on the balance sheet as of December 31st? Cash and cash equivalent. That's what we're looking for right now. Petty cash is cash. XYZ Bank statement checking account is cash, $20,000. So here we have $20,500. Marketable equity security. Equity is never cash. Equity is equity, okay? Marketable equity security. So equity is never cash. So you don't need to do anything with this. Marketable debt security could be cash if it's short term, less than 90 days. But if it doesn't mention that, you don't need to assume it's not cash. Marketable debt security, if it was short term marketable debt security, it could have been cash equivalent. But now it doesn't say short term, it doesn't say 90 days, whatever. So we will not consider it as cash equivalent. Bank depository account, $5,000. Here we have $5,000, $25,500. Yes, $25,500. That's it. Okay, excellent. That's correct. Bank depository account. That's a depository account. That's savings account. Let's see. A bank depository account. Is it a savings account? Yes, in most accounting questions, a bank depository account is treated like a savings account or a regular bank account where cash is deposited and readily available. Okay. Got it. All right. The company's monthly bank statement shows a balance of $18,000. Bank statement. Okay. So here we're working with the bank statement. Reconciliation of the statement with the company books reveal the following information. Bank service charge, $10. Insufficient funds check, $350. Outstanding checks, $1,200. Deposits in transit, $450. Interest income, $116. Check deposited by the company and cleared by the bank for $180, but improperly recorded by the company as $108. What is the net cash balance after the reconciliation? They are asking for cash balance, but they started the question with the bank statement. And I'm going to do the same thing again. I will reconcile the bank statement, because if I want to reconcile the books, it will take me a way more work. So I will only reconcile the bank statement. We start with $18,000 in a bank statement. We have a bank service charge of $10, which we don't need to do anything with because the bank already knows. Insufficient funds check, $350. We don't need to do anything with this because the bank knows that. So it has already made the adjustment in the $18,000. Outstanding checks. This needs to be adjusted because this is a check that I have written to a client. No, to a supplier, let's say. I wrote the check to the supplier. I sent the check, but they have not cashed it yet. So my bank thinks that that money is mine, but I know that money is not mine because I already sent the check. I already mailed the check. So from the $18,000, I need to subtract $1,200. The check is for $1,200. So 18,000 minus $1,200, $16,800. I have deposits in transit. These are deposits that I made but the bank is not seeing them yet, or a payment a customer made via ACH, but it is not yet showing on my bank account, I need to add that. Plus $450, $17,250. Interest income. Interest income. If there is interest income, so the bank pays me interest. I believe the bank already knows about the interest. I don't know yet, but the bank knows. So the bank will make the adjustment by itself, so I don't need to adjust the bank statement. There is a check deposited by the company. It was cleared by the bank for $180, but I made a mistake on my books. I recorded the check as $108. So that's it. There is nothing I need to do with that because the bank has the right amount. The bank has the right amount, which is $180. So I don't need to do anything with that. So what is the net cash balance? It should be $17,250. That's what it should be, $17,250. Now, one thing I'm not sure yet about is the interest income. If that income is coming directly from my bank or is it coming from somewhere else? If it's coming from somewhere else, we may need to do an adjustment, but that's correct. I mean, the answer is correct. So no additional thoughts on that. $17,250. So interest payment, interest income is interest that's coming from the bank. When the bank is paying you interest, the bank knows that it's paying you interest. So the bank doesn't need to make you don't need to make any adjustment. The bank has made the adjustment already. Okay. The company purchased a 3-month U.S. Treasury bill. This is cash equivalent if it's 3 months. In preparing the company's statement of cash flows, this purchase would be cash equivalent. So in preparing the company's statement of cash flows, they're asking how would you show this treasury bill? It says have no effect, be treated as an outflow from financing activities, be treated as an outflow from investing activities, be treated as an outflow from lending activities. 3-month U.S. Treasury bill. It's 3 months. It is a cash equivalent. Treated as an outflow from financing activities. Be treated as an outflow from investing activities. Well, in this case, I'm going to say it's an investing activity because it should not be an investment. It shouldn't be an investment. It is cash equivalent. Be treated as outflow from financing activities. It's not financing activities. It's not lending activities. It's not investing activities. I would say have no effect. Pray for me because this is what I'm going to take. I'm going to say have no effect. Yes, that's correct. Oof, man, this was hard. Because it was easy to say it's investment, but since it is 90 days or less, it's not investment. It is cash equivalent. So it's just cash. There is no effect. This is good. Cash flows from operating activities. Cash flows related to the production of income from continuing operations. Net cash provided used by operating activities, cash flows from investing activities, cash flows from purchase and sale of long-term assets. All right, so when we're talking about investing activities, it's cash flows from purchase and sale of long-term assets. Net cash provided or used by investing activities. That's how we'll be showing. Cash flows from financing activities is cash flows from issuance and repayment of debt and from transactions with owners. Net cash provided used by financing activities, net increase or decrease in cash, beginning cash balance, ending cash balance. All of these are cash flows from financing activities. All right, so this is what we need to understand. The statement of cash flows reports cash inflows and outflows based on the nature of the cash flows, operating, investing, and financing activities. Adding the net increase or decrease in cash from the three categories to the beginning cash and cash equivalents reconciles the ending cash and cash equivalents. Okay. Cash equivalent, treasury bill, money market funds is a financial instrument that is easily convertible into a known amount of cash, highly liquid, and has an original maturity of 3 months or less from the date of purchase. Because a cash equivalent is so close to maturity, there is little risk of change in value. The purchase and sale of a cash equivalent is part of the entity's cash management activities, not part of the operating, investing, or financing activities. All right, that's what we need to know. All right, let's say the company's monthly bank statement shows a balance of $54,200. All right, here we're talking about the bank statement again. Reconciliation of the statement with the company books reveal the following information. Bank service charge $10, insufficient funds check $650, check outstanding $1,500, deposits in transit $350, check deposited by the company and cleared by the bank for $125, but improperly recorded by the company as $152. The same question. What is the net cash balance after the reconciliation? Okay. So we start with what I'm gonna do. I will be adjusting or reconciling the bank statement, not the cash. Even if they ask me for the net cash balance, I'm not going to be reconciling the cash. I will only be reconciling the bank statement because I have more information for the bank statement than what I have for cash. Okay? Because I don't have the beginning cash balance. If I had the beginning cash balance, I would reconcile the cash balance. But I don't have the beginning cash balance, but I do have the beginning bank statement balance. So that's what I'm going to be working with. So we have $54,200 bank service charge. Bank service charge $10. I don't need to do anything with this because the bank already knows. Insufficient funds check $650. I don't need to do anything with this because the bank already knows. Check outstanding. This the bank does not know. This is a check that I have written to a supplier. I mailed the check to the supplier. Remember, if I have not mailed the check, this is considered as cash in my pocket. I should not reconcile this. But if I have mailed the check, Yes, the bank does not know. So this is a check that I need to subtract from my bank statement or from my bank balance. So $54,200 minus $1,500, we have $52,700. Deposits in transit. This is the deposit that I made. The bank does not know, but I know, and I have adjusted that in my books. The bank does not know yet because it's not yet reflected in my bank statement. So deposits in transit, $350 plus $350. Okay, $53,050. Check deposited. Whatever check that I have deposited that has been cleared in my book, I made an error in my book, but the bank has the right amount. The bank doesn't care anymore about my error. So I was just reconciling the bank statement. So I have $53,050. And that should be the cash balance because it's a reconciliation. Cash balance and bank statement. So the bank statement and the cash balance, they need to balance. So that's why whatever I get for the cash for bank statement is the same amount that I would get for cash balance. $53,050. Excellent. Let's keep going. The company has a checking account at Red Bank and an interest-bearing checking account at Blue Bank. On December 31st, year one, the company's bank records reflect the following information. Bank balance 50 in a Red Bank, that's the first bank. Bank balance $50,000. Deposit in transit $5,000. So here in Red Bank, it should be $55,000. You know why? Because there is a deposit in transit that the bank does not know yet. Blue Bank, bank balance $3,000. Outstanding check $7,000. You see here in Blue Bank, I have $3,000 in as money cash balance, but I have a check that I have written to a supplier for $7,000. I don't have $7,000 in the bank. Now, when they cash this check, I'm gonna have an overdraft fee, an overdraft amount on my account. It's gonna be $4,000 overdraft because I only have $3,000 in the bank. So my first bank, I have a cash balance of what? Of $55,000. Even if the bank balance says $50,000, but I have the deposit in transit of $5,000, so the total is $55,000. In Blue Bank, I will consider that I have a $4,000 overdraft. What is the question? The question is, what amount should be classified as cash on the company's balance sheet at December 31st, year one? Okay, so how much money do you have as cash? $55,000. On one account, I have $55,000. On the other account, I have an overdraft of $4,000. Now, since it is different, they are two different banks, I cannot adjust one bank on the other bank. If it was the same bank, two different accounts, I would go ahead and do it net of whatever it is, okay? So my cash balance is $55,000. That's correct. The following bank reconciliation is presented for the company for the month of November, year one. Balance per statement, November 30th, year one, $18,040. Add deposit in transit, $4,150. Lost outstanding checks, less outstanding checks, $6,300. Bank credit recorded in error, $20. That makes it $6,320. Balance per books, November 30th, year one, $15,870. Data for the month of December, year one, per bank follows. Data for the month of December. December deposits, $26,100. December disbursements, $22,420. Balance as of December 31st, year one, $21,720. All items that were outstanding as of November 30th cleared through the bank in December, including the bank credit. In addition, $2,500 in checks were outstanding as of December 31st, year one. What is the balance of cash per books at December 31st, year one? It says that all items that were outstanding as of November 30th cleared through the bank in December. When it says cleared, that means it gets to a zero balance. It gets to a zero balance at November 30th, including the bank credit. Okay. So now December deposits, $26,100. December disbursement, $22,420. And here they say the balance as of December 31st, year one, is $21,720. And there is an outstanding check, which would be adjusted, $2,500. So, okay, let me see what's going on here. Let me see what's going on. All right, cool. Let me understand something. I should do it myself and see if I understand. December deposits, $26,100. December disbursements, $22,420. Balance, December 31st, year one, $21,720. Let me say that balance per books, November 30th, year one, $15,000. Let me start with the $15,870 to see what happens. That I ended November with $15,870. There is the deposit in December. December deposits, $26,100. I'm gonna say plus $26,100. We have disbursements of $22,420 minus $22,420. Okay. Here I have $19,550 to $19,550 plus the the check, the check, oh no, not plus, minus the outstanding check, minus $2,517,050. Ooh, no, my thoughts are not right. So we need to get this right. We need to get this right. Okay. All right. The following bank reconciliation is presented for the company for the month of November, year 1. Balance per bank statement, November 30th, year 1, $18,040. Add deposit in transit, $4,150. Less outstanding checks, $6,300. Bank credit recorded in error, $20. Makes it $6,320. Balance per books as of November 30th, year 1, $15,870. Data for the month of December, year 1, per bank follows. December deposits, $26,100. December disbursements, $22,420. Balance as of December 31st, year 1, $21,720. All items that were outstanding as of November 30th cleared through the bank in December, including the bank credit. In addition, $2,500 in checks were outstanding as of December 31st, year 1. What is the balance of cash per books at December 31st, year 1? Okay. Now we need to understand that. Step 1, find December deposits in transit. Bank deposit during December, $26,100. December deposits, okay, $26,100. The November deposits in transit of $4,150 cleared in December, so part of the December bank deposits belong to November. Oh, okay. Therefore, December deposits actually recorded in the books and not yet reflected by the bank. 26,100 minus 4,150, that gives me $21,950. Now compare the bank balance movement. Step 2, calculate deposits in transit at December 31st. Start with bank balance on November 30th, $18,040. $18,040 balance per bank statement. Okay. Add December bank deposits. Add December bank deposits. All right. $26,100. Okay. Less December bank disbursements. Okay. Less December bank disbursements. $22,420 equals December 31st bank balance, $21,720. We are told outstanding checks at December 31st was equals $2,500. To reconcile bank to books, we need deposits in transit. Step 3. Compute December 31st deposits in transit. Cash per books on December 31st, we don't know. Use book cash equals bank balance plus deposits. Bank balance, book cash, bank balance plus deposits. So we need the deposits in transit. December book receipts, $26,100 minus $4,150 equals $21,950. December book disbursements. So what's the question again? What is the balance of cash per books at December 31st, year 1? December deposits, December disbursements. Okay. Balance per bank statement. Okay. Data for month December per bank is follows. In this case, I feel it's getting a little bit confusing. Why don't we reconcile the bank statements, not the books? Let's only work on the bank statements, and then we may work on the books if we need to. Because generally, when we reconcile the bank statement, it is the same as the books. So let's only work on the bank statements. Adjust the bank balance equals adjusted book balance. So if you can get adjusted bank balance, you're done. No need to reconstruct the books. Let's do it entirely from the bank side. Yes. November reconciliation. Bank balance as of November 30th. The $18,040. Let me look at it from here too. Okay. Balance per bank statement, $18,040. Balance, okay. Add deposit in transit. Deposit in transit, $4,150. Yes. Less outstanding checks, $6,300. Yes. Less bank credit recorded in error, minus $20. Yes. Adjusted balance is $15,870. This agrees with the books. Okay. December bank activity. Ending bank balance December 31st is $21,700. Now ask, what items are still causing a difference between the bank and books on December 31st? We are told all November outstanding items cleared. Outstanding checks on December 31st equals $2,500. No deposits in transit is given. On these questions, if no deposit in transit exists at December 31st, assume 0. So $21,720 minus $2,500 Answer is $19,220. This is way faster. Bank balance $21,720. Less outstanding checks $2,500 equals adjusted balance $19,200. And because adjusted bank equals adjusted books, the cash balance per book is $19,200. Okay. There, I was lost a little bit somewhere. Let me go back so that we understand everything. Okay. November reconciliation. We know we start the bank balance with $18,040. There is the deposit in transit, $4,100, $150. We add that. Minus $6,300 of outstanding checks. Minus $20 in error. Adjusted balance is $15,870. That's good. This agrees with the books. Okay. This is for November. Now we get into December. December bank activity. Ending bank balance for December, they give you ending bank balance is $21,720. Okay. Now ask, what items are still causing a difference between the bank and books on December 31st? We are told all November outstanding items cleared. Outstanding checks, okay, no, I need to understand this part. When it says all November outstanding balance, all November outstanding items cleared, what does that really mean? Are we starting December with zero balance, or what does that mean? Great question. No, it does not mean we start December with a zero balance. It means the reconciling items from November are no longer reconciling items in December. Think of it this way. November 30th, bank says $18,440. $18,040. Books say $15,870. The difference is caused by deposit in transit $4,150, outstanding checks $6,300, bank credit error $20. Okay. These items explain why the bank and books don't match on November 30th. Okay. What happens in December? The statement says all items that were outstanding as of November 30th cleared through the bank in December. That means deposits in transit, the $4,150 deposit finally shows up on the bank statement. Before books had it, bank did not. After it clears, the books had it, bank has it too. Okay? No longer a reconciling item. Outstanding checks. The $6,300 of checks finally clear the bank. Before books already recorded them, the bank had not paid them. After they clear, books have them, the bank have them, X has them. No longer a reconciling item. A rule. When they say all November outstanding items cleared, translate it as forget the November reconciling items. They are gone. You do not forget the November balances. You still start December with bank balance of $18,040. Book balance $15,870. But the November deposit in transit and outstanding checks are no longer differences at December 31st. That's why at December 31st, you only worry about new reconciling items, such as the $2,500 outstanding checks still remaining at year end. So when you read all November outstanding items cleared, think the November reconciliation has been resolved. Start with the November balances, but ignore the old reconciling items because they have already passed through the bank. So that being the case, we are starting December with a reconciled balance sheet. So there is no more reconciliation to be done in that's outstanding from November in December. Exactly. That's the way I would think about it on the exam. When the question says all items that were outstanding as of November 30th cleared through the bank in December, you can mentally say November is finished. The November reconciliation is complete. So at the start of December, your effective reconciled cash balance is $15,870. Both the bank and the books will eventually arrive at that same amount once the November reconciling items clear. The old items, deposit in transit, outstanding check, bank credit error, are no longer differences between the bank and books. Therefore, when reconciling December, you only look for a new December reconciling items such as new deposit in transit, new outstanding checks, bank errors, non-sufficient fund checks, service charges, interest earned. A shortcut I use is November adjusted bank equals adjusted books, $15,870. December start from the reconciled amount, $15,870. Add December activity and then adjust only for December outstanding items. Okay, that makes sense here. So let me go back to November to see what I have. November, $15,870. Okay, so now in December, I have deposit of $26,000. This is what I did. Okay. Trying to understand that. So if I start, I know November balance per books, November 30th, year one, $15,870. This is correct in the book, also correct in the bank statement. So it has been reconciled completely. Now, this balance is being transferred to December because it is at the end of November. It is at the beginning of December. Now, we have December deposits of $26,100. We will add the $26,100 on the $15,870. We will subtract the disbursement and then subtract the outstanding check. Is that what we're doing? Yes, that's exactly the logic, and it's a much more intuitive way to think about it. Step one, start with the reconciled balance. As of November 30th, we have $15,870. Since November has been fully reconciled, treat this as the true cash balance going into December. Okay. Step 2, add December deposits. $15,870 plus $26,100. That's $41,970. Okay. Step 3, subtract December. December disbursements. Disbursement is $22,420. Okay, so $41,970 minus $22,420. That's $19,550. At this point, you have the bank's December 31st balance before considering any December reconciling items. Notice $18,040 plus $26,100 minus $22,420 equals $21,720, which matches the ending bank balance given. Where it is coming from? $18,040 plus 26 minus 22. Hey, don't confuse me. Don't confuse me here. Okay, so don't confuse me. All right, so far I'm good. So far I'm good. Which match? Okay, step 4. Step 4, adjust for December outstanding checks. The $22,420 disbursement shown by the bank do not include the $2,500,000 of checks that have been written and recorded in the books but have not yet cleared the bank. Therefore, the books are lower than the bank's by $2,500. So 21, where is this 21,000 coming from now? Because what I had was 19,550. Subtract December disbursement. Okay, at this point you have bank's December 31st December before considering any. Okay, all right, I was lost here. So I am lost here. We got to the point where we start December with the balance of November $15,870 plus December's deposit $26,100 minus December's disbursements $22,420. Now I have $19,550. Okay, what adjustment do I make from $19,550 that will give me that $21,720? The number $22,420 is a bank number, not a book number. Okay. The number 22,000, where is this coming from? 22,420 disbursement. Okay. The number 22,420 is a bank number, not a book number. Let's look carefully. You did $15,870 plus $26,100 minus $22,420 equals $19,550. The problem is that you're mixing beginning book balance $15,870, December bank deposit $26,100, December bank disbursements $22,420. That doesn't necessarily give you the ending book balance. Let's compare the two paths. Bank path. Start with November. That's what I've been doing. With November bank balance $18,040. Add December deposits $26,100. Less December disbursements $22,420 equals $21,720. This is the ending balance given in the problem. Book path. I don't need book path. I don't need the book path. I only need the bank path right now. So we can avoid any confusion. I only want to work with the bank part. All right. Forget the book completely, yes. November reconciliation. Bank balance $18,040. Add deposit in transit $4,150. Less outstanding checks $6,300. Less bank credit error $20. Adjusted bank balance $15,870. Okay, this is the true cash balance on November 30th. Understand? December bank activity. Start with the November bank balance, not the reconciled balance. Oh. Okay. Start with the November bank balance, not the reconciled balance. Okay. November bank balance is $18,040. Now add December deposits $26,100. Less December disbursements $22,420. Ending balance $21,720. This agrees with the problem. Now reconcile December 31st. I know there is this outstanding check minus the outstanding check at December 31st. That's it. Okay. I understand. Okay, now why do we start with November bank balance, not reconciled balance? Now, why do we start with the November bank balance, not the reconciled balance? Excellent question. The answer is you don't have to. In fact, if your goal is to find the true cash balance, starting with the reconciled balance is often easier. Okay. The reason I started with the November bank balance was simply because the problem gives December bank activity. Okay. And that reproduces the December 31st bank statement balance. But conceptually, you're thinking about it correctly. November reconciliation bank balance $18,040 adjusted for outstanding items $15,870. Now November is reconciled. Your reasoning, you can say the true cash balance entering December is $15,870. That's what I need. That is perfectly valid. The problem is that the December deposits $26,100 and December disbursements $22,420 are bank activity, not necessarily reconciled cash activity. So if you start with the $15,870 and then subtract those bank numbers, you're mixing a reconciled balance with unreconciled activity. That's why the math doesn't follow cleanly. The shortcut I would use on the exam, forget the November balances entirely. Look only at December 31st. Bank balance. Okay. $21,720. Outstanding checks $2,500. Therefore, $21,720 minus $2,500 equals $19,220. Done. Oof. I know it was easier than that. I knew it was easier than that. I know it was way easier than what they were showing me. All right. So you start with the balance as of December 31st, year one, and then subtract the outstanding check. Oof. This is way easier than what we're doing here. Start with December bank balance, which is the $21,700. Ending bank balance of December, $21,720, and then adjust for outstanding checks. And that's it. For this particular question, that's exactly the simplest approach. What the problem is really telling you by saying all items that were outstanding as of November 30th cleared to the bank in December, the exam is basically saying ignore the November reconciliation. It has already been resolved. So when you get to December 31st, the only thing that matters is bank balance. All right, it's time for break. After break, we continue.
Credit sales times 365. Day sales outstanding. Average accounts receivable. Over net credit sales times 365. Day sales outstanding. Average accounts receivable. Over net credit sales times 365. Day sales outstanding. Ending accounts receivable. Over net credit sales times 365. Day sales outstanding. Ending accounts receivable. Over net credit sales times 365. Day sales outstanding. 365 over accounts receivable turnover. Days sales outstanding 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding 365 over inventory turnover. Days inventory outstanding 365 over inventory turnover. Days inventory outstanding 365 over inventory turnover. Times interest earned, EBIT over interest expense times interest earned, EBIT over interest expense times interest earned, EBIT over interest expense. Accounts receivable turnover, net credit sales over average accounts receivable. Accounts receivable turnover, net credit sales over average accounts receivable. Accounts receivable turnover, net credit sales over average accounts receivable. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Inventory turnover, cost of goods sold over average inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Cost of goods sold, beginning inventory plus purchases minus ending inventory. Gross profit, sales minus cost of goods sold. Gross profit, sales minus cost of goods sold. Gross profit, sales minus cost of goods sold. Return on assets, net income over average total assets. Return on assets, net income over average total assets. Return on assets, net income over average total assets. Return on assets, income over average total assets. Return on equity, net income over average stockholders' equity. Return on equity, net income over average stockholders' equity. Return on equity, net income over average stockholders' equity. Debt ratio, total liabilities over total assets. Debt ratio, total liabilities over total assets. Debt ratio, total liabilities over total assets. Debt to equity ratio, total liabilities over stockholders' equity. Debt to equity ratio, total liabilities over stockholders' equity. Current ratio, current assets over current liability. Current ratio, current assets over current liabilities. Current ratio, current asset over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Net profit margin, net income over sales. Net profit margin, net income over sales. Net profit margin, net income over sales. Day sales outstanding. Day sales outstanding, average accounts receivable over net credit sales times 365. Day sales outstanding, average accounts receivable over net credit sales times 365. Day sales outstanding, average accounts receivable over Credit sales times 365. Days sales outstanding. Ending accounts receivable over net. Credit sales times 365. Days sales outstanding. Ending accounts receivable over net. Credit sales times 365. Days sales outstanding 365 over accounts receivable turnover. Days sales outstanding 365 over accounts receivable turnover. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days inventory outstanding 365 over inventory turnover. Days inventory outstanding 365 over inventory turnover. Days inventory outstanding 365 over inventory turnover. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio.
All right, well, back to work. We are back to work. Okay, so we've been working on this problem right here. That was a little bit complicated, but seems to be easier than what we thought. So I'm going to read this question again. The following bank reconciliation is presented for the company for the month of November year 1. Balance per bank statement is as of November 30th year 1, $18,040. You add deposit in transit. Deposit in transit, $4,150. Less outstanding checks, $6,000 $300. So they are doing the work for us. Bank credit recorded in error is $20 minus $20. So negative $6,320. Balance per books. Balance per books 11/30th year 1 is $15,870. Guess what? They start the question with balance per bank's statement. They finish the question of the month with balance per books. Now, wow. Okay, so 18,000 minus 6,000. Wait. All right, let me do this real quick. Okay, let me do this real quick to see something, because I need to understand this question completely. $18,040 plus $4,150. Okay. Oh. Okay, let me I have a call. I need to take this call real quick.
Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, 365 over accounts receivable turnover. Day sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 3.
Okay, let's get back to work. Gotta take care of many things. All right, so what I was doing is, let me go back. Let me read the question again. Okay. The following bank reconciliation is presented for the company for the month of November, year 1. Balance per bank statement as of November 30th, year 1 is $18,040. Okay, $18,040. This is at the end of November, not at the beginning of November. This is at the end of November. Okay? $18,040. And guess what happens? Balance per books at the end of November is $15,870. So there is a difference. And the difference is 18,000 All right, the difference is $18,040 minus 15,870. The difference is $2,170. We have a difference. The book and the bank do not balance. So we need to reconcile them. So let's see what happens. $18,040 plus 4,150. Outstanding checks minus 6,300 minus 20. Exactly. So this is $15,870. Okay. So they gave me the bank balance, or the bank statement balance. They gave me the book balance, and they also made the reconciliation for me too. So in this case, the bank in the book at the end of November, there is a reconciliation that has been done. Excellent. So data for the month of December, year 1, per bank follows. Okay, December deposits $26,100. December disbursements $22,420. Balance. The balance for December 31st, year 1, is $21,720. That's the bank balance. Okay. I have the bank balance, the reconciliation for November. The balance for December is $21,720. $21,720. And this amount comes bank balance statement for November $18,040 plus December deposits. Let me see. $18,040 plus December deposits $26,100 minus December disbursements $22,420 equals $21,720, which is the ending balance for December. And here's what I am understanding here. I could have started with the reconciled balance of November and bring it into December because it was at the end of November. But what's going to happen is that the December deposit is not yet reconciled. December disbursement. So now it would cause me to have a different balance for December. But by using the balance per bank statement, which is unreconciled, balance for November. I use the unreconciled balance for November. I bring it into December. And then now I have the ending balance for December, which is $21,720. So guess what? It says all items that were outstanding as of November 30th cleared through the bank in December, including the bank credit. In addition, $2,500 in checks were outstanding as of December 31st, year one. So the only thing I need to be working with here is the outstanding checks. So deduct or subtract the outstanding checks from the ending December balance. And that's going to give me the result. So in a particular question like this, when they give me that statement, all items that were outstanding as of November 30th cleared through December, and then they give me an ending balance for December. So I would just adjust the ending December balance. And when you do the math, it should match. It should match. Okay. So, but I still don't know exactly why I am using the unreconciled November balance. Balance per bank statement, November 30th, year one. Balance. I know why. Now I know why. Okay, I know why I'm using the unreconciled balance. It is because I'm bringing it to December, and in December, I'm using bank numbers. I'm not using book numbers. So the $15,870 is a book number. It's the reconciliation of the book with the bank. But it is a book number. And they clearly say it, balance per books as of November 30th, year one is $15,870. This is a book number. In December, I am using bank numbers. So I'm not supposed to mix book numbers and bank numbers. That's good. That's good. That's good. That's why the number I need to bring to December is the bank statement balance of November. Bank statement balance is, and it says it clearly, as of November 30th, year one. So this bank balance is ending November. If it's ending November, it's beginning in December. It's the beginning of December. If it's the ending of November, it is the beginning of December. If it's the ending of November, it is the beginning of December. Now, if I was using book numbers in December, I would use the $15,870, which is the balance per books. Which is the balance per books. This is a revelation, my friend. This is a revelation. Okay, that makes perfect sense. Makes perfect sense. Balance per bank statement as of November 30th, year one, is $18,040. They gave me all these numbers. They made the reconciliation for me. That's good. Now the balance per books is $15,870. I have two balances at the end of November. Now I need to find December number. I need to find December cash balance, but I'm not gonna be working with the cash balance because guess what they did? They did not give me books numbers in December. They gave me bank numbers in December. So that's why I am only gonna be working with the bank numbers. And if I can reconcile the bank, it is equal to the book or to the books. That's the thought. Okay, that's good. This is good. I love this. Yeah. Okay, yeah, I think that's it. That's it. You cannot mix book number and bank number. If you're working with books number, you need to finish with books number. If you're working with bank numbers, you gotta finish with bank numbers. Okay. All right, that's good. Okay. The December 31st year one balance per bank is given as $21,720. The only reconciliation item at December 31st year one is outstanding checks, $2,500. Therefore, the correct balance per bank at December 31st year one is $19,220. That's way easier than what I thought. Okay. Good job, good job. All right, let's take another set of 10 questions. We're moving forward. Cash and cash equivalents, 11. We have 11 questions left. Let's do them. After that, we will be attacking trade receivables. Trade receivables. And then inventory, property, plant, and equipment. We're moving forward, my friend. Okay. We can breeze through these. Hilltop or the company's monthly bank statement shows a balance of $54,200. What is it? Bank statement. Okay. Reconciliation of the statement with the company books reveal the following information. Bank service charge, $10. Insufficient funds check, $650. Checks outstanding, $1,500. I did that already. Deposits in transit, $350. Check deposited by the company and cleared by the bank for $125, but improperly recorded by the company as $152. What is the net cash balance after the reconciliation? Okay. Net cash balance after the reconciliation. I don't have book numbers. I don't have the book balance. So I'm not going to be reconciling the books, I'm going to be working with the bank statement. Okay. Starting with $54,200. Bank service charge, no adjustment needed. No adjustment needed because the bank already knows. Okay? The bank knows already. Insufficient funds check. No adjustment needed. The bank already knows. You know why? Because somebody deposited a check for me. They say, hey, Wilkin, I'm going to make a payment. I recorded this in my books. Somebody made a $650 payment, but it wasn't, they didn't have money to make the payment. The check bounced. The bank clears that and that's it. Okay. The bank knows, I don't know, but the bank has no, the bank takes care of that for me. Checks outstanding. Checks outstanding. This is me. I have written a check. I have written a check to a supplier. I mailed the check. The supplier has not deposited the check to withdraw that money from my bank account. So I need to subtract that from the $54,200. Okay. $54,200 minus $1,500. Okay. I have deposits in transit. This is money that I have deposited in my bank account that is not yet available in the bank account, so the bank statement is not seeing it yet. So I need to add that amount plus $350. Okay? Now, check deposited by the company and cleared by the bank for $125. It was cleared. So when the check is deposited, the bank cleared the check. It is already reported in the balance. That's it. There is nothing that I have to do. Even though I have recorded it in my books with an error, I need to fix my book. I don't need to fix the bank because the bank has no problem. Okay? So now it's $53,050. That's the bank statement reconciliation. If it's the bank statement reconciliation, it is also equal to the books reconciliation, $53,050. $53,050. Excellent. Let's keep going. The company's checkbook balance on December 31st was $10,000. On that date, the company held the following items in its safe. $4,000 check payable to the company post dated January 3rd and not included in the December 31st checkbook balance. In collection of a sale made in December. Even though the sale was made in December, this is revenue, but this is not cash. Remember, if it's a post-dated check, it's not cash. So you cannot report cash in December. Okay. $1,000 check payable to the company deposited December 15th and included in the December 31st checkbook balance, but returned by the bank on December 30th, stamped non-sufficient funds. The check was deposited on January 2nd and cleared on January 9. What amount should the company report as cash in its December 31st balance sheet? All right, cash. We know we're working with cash, which is the books, but I'm gonna be working with the bank because I have the balance, the checkbook balance in December. All right, checkbook balance. Oh no, that's not bank statement. This is the checkbook balance. All right, the company's checkbook balance. This is the books. All right, finally, I have the books. So I'm going to be working with the books. As of December 31st, $10,000. On that date, the company, okay. So we had $10,000 in the book, recorded in the book. But there is a $4,000 check payable to the company that was post-dated January 3rd and not included in the December 31st checkbook balance. So there's nothing you need to do with this. It's not included. It is post-dated. Nothing to do. Okay, leave it just as is. $1,000 check payable to the company, deposited December 15th. They deposited that money December 15th. In that case, it is recorded in the books and included in December 31st checkbook. Yes. Okay. But returned by the bank on December 30th. Stamped non-sufficient funds. So you need to subtract this from the books. The check was redeposited on January 2nd and cleared on January 9th. This is January cash. It's not December cash. So you need to subtract $1,000 from $10,000. So it's going to be $9,000. The question is, what amount should the company report as cash in December 31st balance sheet? $9,000. This is the only adjustment we need to make. This $1,000 non-sufficient fund, you need to remove it from the cash of December. It will be reported in January's cash. Excellent. That's good. The company had the following bank reconciliation at March 31st. Bank reconciliation. Okay. Balance per bank statement. Remember here, we are starting with balance per bank statement, not books, not checkbook. 23 as of March 31st. So the end of March, March 31st is $23,250. We add deposit in transit. At deposit in transit, $5,150. All right. So you add that. It makes it $28,400. So they're doing the work for me. Less outstanding checks, $6,300. So less $6,300. Balance per books. Ha. You see? Balance per books as of March 31st is $22,100. We have two balances here. Okay? We have balance per bank statement. We have balance per books. Balance per bank statement is $23,250 as of March 31st. Balance per books as of March 31st is $22,100 after we made the reconciliation. That's good. I understand this so far. Additional information from the company's bank statement for the month of April is as follows. Deposits, $29,200. Disbursements, $24,800. See what they say? Additional information from the company's bank statement. Not from the book, but bank statement. So these numbers here are bank numbers. Deposits, $29,200. Disbursements, $24,800. Okay. All reconciling items at March 31st cleared through the bank in April. Outstanding checks at April 30th total $3,200. What is the amount of cash disbursements per books in April? All right, so now we need to know what's going on in the books. Okay, We need to know what's going on in the books. The books balance. But guess what? Here, all right, you see here in April, they did not give me the ending balance for April. Okay? They gave me the ending balance for March. I have the book, I have the bank. I'm gonna be working with the bank. The only reason is because the numbers that I have in April are bank numbers. That's why I'm gonna be working with bank numbers coming from March. So what bank numbers do I have in March? The March bank number is March 31st, $23,250. $23,250. I think I'm going to be a teacher of this after I'm done. I'm going to be teaching this. Okay. Balance per bank statement, March 31st, $23,250. We're going to take this balance and bring it to December. Why we're not taking the book balance, the reconcile balance at the end of March is because the numbers I have in April, they are not books number. They are not books numbers. They are bank numbers. So that's why I'm using the bank balance, the ending bank balance, okay? So $23,250. Deposits. Plus the deposit, $29,200 plus $29,200 minus disbursements, $24,800 minus $24,800. So I have ending balance for April is $27,650. This is ending April bank number. Let me say it like this. Ending April bank number. Okay? Why did I use $23,250 if it is a March number? Yes, it is a March number, but it is the ending March number. Ending March number is beginning April number. This is good. Ending March number is beginning April number. So that's why I need to bring that number to April. Okay? All right, so ending April number, bank number, okay? Ending April bank number is $27,650. They say all reconciling items at March 31st cleared through the bank in April. I don't care about that. Outstanding checks at April 30th total $303,200. So we have an outstanding check. This is a check that I have written to a supplier. I mailed the check, but they have not cashed it. And it was at the end of April. It was at the end of April. So I need to subtract this from my bank number. So here, 3,200. And the number, the reconciliation is 24,450. Remember, if I can reconcile the bank, 24,450, 3,200. If I can reconcile the bank, I don't need to reconcile the books. But here there is something that's off. 23,250. Balance per books. Okay, something. I have 24,450. 24,800. Understand? something is wrong here. Minus 2,000, 3,200, 3,200. Okay. Outstanding checks at April 30th total $3,200. What is the amount of cash disbursement per cash disbursement? I'm not looking for cash balance. That's a trick. The question is not cash balance, but cash disbursements per books in April. All right. So I what? This is beautiful. Okay. Disbursement that I had in April was $24,800. I also have a check. Wait. What is the amount of cash disbursements? They are playing with my brain. They are playing with me. What is the amount of cash disbursements per books in April? It says it here. Disbursement is $24,800. There is an outstanding check at April 30th, total $3,200. But even if I have this, I should have recorded this as a disbursement. Even if it is an outstanding check, when I write the check, I had to put it in my books as a disbursement. So I don't need to add this $3,200 again, even if it is outstanding. Pray for me. Because they say that disbursements in April is $24,800, and this is what I am going to take. And it says no. So I need to subtract the, let me see, 24,800. That's wrong. 24,800 minus 3,200. 21,600. Even so, it's still off. Because they say the answer is 21,700. Where is this coming from? What? Okay. Let me see the notes. Okay, let me see. Bank reconciliations are used to reconcile differences between the cash balance per bank in the company's books to arrive at a corrected cash balance. Most reconciling items are due to either errors or timing recognition differences. Okay. The company wants to verify its cash disbursements, not to reconcile cash balance. March outstanding checks. March outstanding checks of $6,300 represent checks that reduce the book cash balance, but not the bank's balance. Because these checks have cleared the bank in April, they are included in April's $24,800 bank disbursement. Yes. Okay. April outstanding checks of $3,200 are recorded on the books but have not cleared the bank. That means excluded from the $24,800. Using the bank disbursements and information about the outstanding checks, cash disbursements per books for April are $21,700. How could it be? Why it's not $21,600? Because it's $24,800 minus $3,200. Let me see. Disbursements per bank for April, 24,800. March outstanding checks, 6,000. $6,300. Add April outstanding checks, 3,200. Disbursements per books for April, 21,700. An alternative approach to determine the book cash disbursements is to deduct the net decrease in outstanding checks from the bank's April cash disbursements. 24,800 minus 6,300 minus 3,200. No. It's still not clear. Why is it? Okay, let me see. Outstanding checks, 6,300. But that has been cleared. It has been cleared. Wait, 24,800. Let me see that. 24,800 minus 3,200, 21,600. Okay, I need some help. Wow. The company had the following bank reconciliation at March 31st. Balance per bank statement, March 31st, $23,250. Deposit in transit, $5,150. Less outstanding checks, $6,300. Balance per books, March 31st, $22,100. Additional information from the company's bank statement for the month of April is as follows. Deposits $29,200, disbursements $24,800. All reconciling items at March 31st cleared through the bank in April. Outstanding checks at April 30th totaled $3,200. What is the amount of cash disbursements per books in April? This is one of those questions where we cannot use the shortcut because they are asking for cash disbursements per books in April, not the ending cash balance. Let's stay on the bank side as much as possible. Look at April bank disbursements. Bank disbursements in April, $24,800. But this includes the March outstanding checks that cleared in April. March outstanding checks, $6,800. Cleared in April? Outstanding checks. Those checks were written in March, not April. So remove them. $24,800 $6,800 minus $6,300, $18,500. Now we have April checks that actually cleared the bank. Step 2, add April outstanding checks. Add April 30th. At April 30th, there are new outstanding checks. 3,200. These were written in April and recorded in the books, but they have not yet cleared the bank. Therefore, they must be added to the book. Disbursements. What? 18,500 plus 3,200 equals $21,700. Why? Okay, book disbursements equal bank disbursements. 24,800 minus 6,000. I see where it's coming from now. Okay. April. Okay, in March, we had outstanding checks of $6,300. $6,300. They say Oregon on March 31st cleared through the bank in April. Oh, okay. I see. All reconciling items at March 31st cleared through the bank in April. That means the $6,300 cleared in April. So this is not March disbursement anymore. It is an April disbursement. So you're gonna add it to the disbursement of April. You will what? All right, so let me see what's the question. What is the amount of cash disbursement per books in April? Why did you subtract? Okay, this is low. All right, bank disbursement in April is $24,800, but this includes the March outstanding checks that cleared in April. March outstanding checks, $6,300. Those checks were written in March, not in April. So remove them. I see why you removed them. Because the check was written in April. The check was written in March. It was written in March but cleared in April. So you consider it March disbursement. It is a March disbursement. So you need to remove it from April disbursement. You remove March disbursement and you add. All right, when I say March disbursement is the outstanding checks. The outstanding checks that were written in March that are cleared in April, you need to remove them from April's disbursements. Now, there is an outstanding check. There is an outstanding check in April of $3,200 you need to add to April's disbursement. Okay, makes sense. Wow. Let's move forward. The company had the following balances at December 31st, year 4. Money orders, $17,000. Cash in money market account, $43,000. U.S. Treasury bill, Purchased November 1st, year 3. Maturing January 31st, year 5. This is not cash equivalent. Commercial paper purchased December 1st, year 4. Maturing February 28th, year 5. This is a cash equivalent. The company's policy is to treat as cash equivalents all highly liquid investments with a maturity of 3 months or less when purchased. What amount should the company report as cash and cash equivalents in its December 31st year 4 balance sheet? Okay. Money order is cash equivalent. Money orders is cash equivalent. You can change this to cash real quick. $17,000 cash in money market account. 43,000. So 43,000 plus 17. 43 plus 17. Let me see. Don't quote me on that yet. 43 plus 17. I gotta be careful now because sometimes they throw things at you. All right, 60. U.S. Treasury bill purchased November 1st, year 3. This is not cash equivalent, but the commercial paper purchased December 1st is cash equivalent. $150,000 plus 150. That's $210,000. $210,000. Yeah, 210. No more activities. Okay, 210. Let's see. Yes, that's correct. Okay. Cash and cash equivalents. Cash on hand. Demand deposits. Example, checking and savings accounts. Demand deposits. Checking and savings accounts. Negotiable paper, example, money orders, traveler's checks, bank checks, money market account, other investments, if both, easily converted to known amount of cash and matures 3 months or less from date of purchase. Cash and cash equivalents are highly liquid current assets. They include balances in savings, checking, or money market accounts, and negotiable paper. Example, money orders. Other investments are cash equivalents if they are easily converted to known amounts of cash and have a maturity when purchased of 3 months or less. Okay, keep moving. The company had the following balances at December 31st, year 4. Cash in checking account, $25,000. Cash in savings account, restricted for paying long-term debt. Restricted. It is cash, but it is restricted. $125,000. Cash in money market account, $55,000. U.S. Treasury bill purchased December 1st, year 4. Maturing May 30th, year 5. This is not cash equivalent. This is not cash equivalent. What amount should the company report as cash and cash equivalent on its December 31st year 4 balance sheet? Okay. Cash in checking account, $25,000. Cash in savings account, restricted for paying long-term debt. This is long-term. It's not short-term. There may be a difference when it's short-term and long-term. Restricted, $125,000. If it's long-term debt, you can still use it. It's your cash. Cash in money market account, 55,000. So I'm going to be using 25,000 plus 125, that's 150, plus 55, that's $205,000. 205,000. I'm going to say that. It is restricted cash. It is restricted, but paying long-term debt. This is what got me. If I got it wrong, this is what got me. Yeah, I got it wrong. It is restricted for long-term. You cannot use it as cash. Okay. Cash and cash equivalent, cash on hand, demand deposits, like checking and savings accounts, negotiable paper, money orders, traveler's check, bank checks, money market accounts, other investment, if both, easily converted to known amount of cash and matures 3 months or less from the date of purchase. All right. Investments are cash equivalents only if they have a maturity of 3 months or less when purchased and easily converted to known amount of cash. Restricted cash has limitations. Restricted for paying long-term debt and is not available for general use in an entity's operations because its use is limited. Restricted cash is presented separately from cash. Okay. For long term or short term, whatever it is restricted. So it's separate from cash. In this scenario, the company will report cash and cash equivalent of $80,000 on its December 31st year 4 balance sheet. Okay. Makes sense. I'm not going to fight with you for that. I know if it's restricted, long-term, short-term, it is separate from cash. Okay. The following information pertains to the company at December 31st year 4. Cash balance per book, $12,000. Cash balance per book. That's book balance. Books balance. Cash balance on statement, $18,000. Okay, so that's bank number. Items on bank statement. Bank fee, $25. Customer payment received by bank, $550, which is not yet in the books. Correction of erroneous deposit. Deposit should have been made to a different customer account, $4,734. Cash balance per book unadjusted. Check deposited by the company and cleared by the bank for $378, but improperly recorded by the company as $387. Check drawn on the company's account payable to a vendor, dated and recorded December 31st year 4, but not mailed until January 8 year 5. On the company's December 31st year 4 balance sheet, what amount should be reported as cash? Okay. Oof. All right, let's work with the book. I'm going to be working with the book because I have the book's balance. Cash balance per book is $12,000. Let me make the book adjustment. Cash balance on statement. All right, don't worry about that. Items on the bank statement. Okay. We have $25 of bank fee that is not yet recorded in the book. You add it to the book. Okay. 12,000 plus 25. Plus 25. 12,025. Customer payment received by the bank that is not yet recorded in the book. Plus $550. 12,575. Okay. We have a correction. Correction of erroneous deposit. Deposit should have been made to a different customer account. 4,734. This is the bank. The bank will fix that. The bank will fix that. This has not been recorded in my books, so I don't worry about it. Cash balance per book. Unadjusted. Check deposited by the company and cleared by the bank. Okay, cleared by the bank for $378, but improperly recorded by the company for $387. $387. So you have an extra money here. 78 to 87. That's $9, right? 78 to 80 is $2 plus $7 is $9. Okay, so I'm gonna say minus $9. We have something else. Check drawn on the company's account payable to a vendor, dated and recorded December 31st, year 4, but not mailed until January 8th, year 5. Well, I wrote the check, but I didn't have time to mail it, but we have already put it in the book that we made a payment. We got to add this back to the book. So that's $750 plus $13,316. This is what's supposed to be in the books. 13,316. 13,266. Something is off somewhere. I have 12,000 cash balance per book. Bank fee. Minus 25. I did plus 25. No, minus 25. Minus 25. Minus the bank fee. I did add, right? So 13,341. 13,600. Still off. Okay. Customer payment received by bank. The bank received the payment. It's a payment, but it has not been recorded in the books. We need to add this to the books. Correction of erroneous deposit. Deposit should have been made to a different customer. We're not touching this because that's the bank. Check deposited by the company and cleared by the bank for $378. Improperly recorded by the company. That's $9 minus 9. I'm not seeing where the problem is. Let me adjust the banks to see. Oh wow, time goes by so fast. What? 9 minutes? Just let me adjust the bank. All right. 18,000. Item on bank statement. Bank fee, $25. The bank knows. Customer payment received by bank. The bank knows. No adjustment needed. Correction of erroneous deposit. Deposit should have been made to a different customer. $4,734 minus $4,734. Okay. We have the check deposit. The bank received the right amount. There is nothing that has to be done. Check drawn, payable to a vendor, dated and recorded, but has not. The bank doesn't know, and the bank doesn't have to do anything with this. That's $13,226. 266, yes. So why is it difficult for me to reconcile the books? That's correct. But okay, so let me see the books again, because I'm supposed to be able to do it for the books. The books, right? $12,000. Books, $12,000. Okay. The books, we have 12,000. Bank fees. The bank knows, but the book does not know. We need to remove that from the bank because that's not cash for you anymore. Minus $25. Bank fees. Minus 25. Okay. $550 payment received by bank. The bank received the payment, but the books have not been adjusted, so we need to add because that's money that came in. $550. Okay. The erroneous deposit, we don't need to do anything with this. The bank knows. The bank will fix it. Check deposited by the company. This is $9.78. That's $9. Minus $9. Okay. What else? $750. What do I do with this $750? $750. Add back. Oh yes, I got it. Okay. I don't know what the problem was, but this is right. $13,266. Okay. We got it. We got it on the bank side, on the book side too. That's good. The following are held by the company: cash in checking account, $20,000; cash in bond sinking fund account, $30,000; post-dated check from customer, dated 1 month from balance sheet, dated 1 month from balance sheet date, $250; post-dated check, not cash. Petty cash, $200; commercial paper, mature in 2 months, cash equivalent. Certificate of deposit matures in 6 months, not cash equivalent. What amount should be reported as cash and cash equivalent on the balance sheet? Cash in checking account, $20,000. Cash in bond sinking fund account. What is a bond sinking fund account? What is a cash in bond sinking fund account? Or what is a bond sinking fund account? Is it considered as cash or cash equivalent? Bond sinking fund. A bond sinking fund is money that a company sets aside specifically to repay a bond debt in the future. Think of it as this cash is reserved and cannot be used for normal operations. For example, company issued $1 million of bonds. The bond agreement requires the company to deposit $100,000 cash year into a separate account. Cash. Each year, each year into a separate account. That separate account is the bond sinking fund. Okay. It is cash, physically, yes. It may be sitting in a bank account, money market account, or investments. It is included in cash and cash equivalents. Is it included in cash and cash equivalents? No. Because the money is restricted for a specific long-term purpose. Okay. 2 minutes. Let's go. Wow. So we have $20,000. Post-dated check is not cash. Petty cash, $200, $20,200. Commercial paper matures in 2 months. Yes, this is cash. So that's $27,200. $27,200. All right. That's correct. Let's move forward. All right. So on December 31st, the company has the following bank account and corresponding cash balances. Operating California Bank. Operating Summit Ridge, $400,000. Operating Bakersville, $300,000. Operating Smithville, $50,000. Savings, $500,000. Sedona Bank, check-in, $375,000. How should the company report the above bank account balances in the balance sheet at December 31st? The first bank, California Bank, you have $400,000 negative, $400,000. You have $300,000 in one account, $350, and you have okay, let me see, $850,000 minus $400,000. 850,000 minus 400,000. 450,000. Okay. So we have $450,000 cash in California Bank. Why? No, I need to finish this. No, I need to finish this. Let's go back to work. No, let's go back to work. After I'm done, we can... Yeah, let's go back to work. Okay. So, in California Bank, you have $450,000 cash. In Sedona Bank, you have overdraft of $375. Okay. So how should you report that? Cash of $75,000? No. Cash of $450,000 and liability of $375,000. Yes. That's how you should report it. Because on one bank, you can offset it based on the cash and on the negative and positive that you have. But if it's different banks, you need to report them separately. All right, different bank are reported separately. That's all you need to know. So the cash that I have in California Bank is $450,000 and a liability of $375,000 in Sedona Bank. And that should be correct. Yes. Okay. We're almost done. All right. At June 30th, the company's cash balance was $10,012 before adjustments. Before adjustments. What time is it? Okay. Before adjustments. While its ending bank statement balance was $10,772. While its ending bank statement, ending bank statement was $10,772. Cash balance was $10,012. All right. Check number 101 was issued June 2nd in the amount of $95, but was erroneously recorded in Almon's general ledger balance as $59. The check was correctly listed in a bank statement at $95. Make sense? The bank statement also included a credit memo for interest earned in the amount of $35 and a debit memo for monthly service charges in the amount of $50. What was the company's adjusted cash balance at June 30th? Okay. I'm going to be using the bank number, okay? I'm going to be using a bank number. I find out the bank number is quicker than the book numbers. Cool. So, June 30th, the company's cash balance, $10,000. Adjustment. Before adjustment, well, its ending bank statement balance was $10,772. Okay, $10,772. Okay, $10,772. Check number 101 was issued June 2nd in the amount of $95, but was erroneously recorded in the company's general ledger's balance $59. I don't need to do anything with this because I'm using bank numbers. I should adjust it in the books, but the bank already had the right number. Okay, and they say it here. The check was correctly listed in the bank statement at $95. So no need to do anything on the bank side. I'm using bank number. The bank statement also included a credit memo for interest earned in the amount of $35. All right, the bank already knows. The bank made the adjustment already. The book does not know. If I was using book number, I would adjust this in the books, but I'm using bank number. And a debit memo for monthly service charges in the amount of $50. The bank already knows that. The book does not know. If I was using book numbers, I would adjust this in the books too. That $50 would be deducted from the book number. All right, so now $10,772. $10,772. What? I don't need to do anything with the check because we received the money. The bank received it. Check was corrected, listed. Bank statement. The bank statement also includes credit memo. The bank already knows, reported in the bank. Service charge already recorded in the bank. So there is no adjustment that I need to do at the bank. $10,772. No adjustment needs to be done at the bank. What? So I need to make some adjustment at the books because let me see. I don't need to make. All right, so $10,012 in the books before adjustment. Well, ending bank statement balance was $10,772. Check number 101 was issued June 2nd in the amount of $95, but was erroneously recorded in the company's ledger balance $59. So there is a, let me see, 59 to 95. All right, let me do this first. 59, 95 minus 59, $36. Okay. So 10,012 plus $36. Was it 36? 95 minus 59, 36. Okay. 10,012 plus 36. Plus 36, 10,048. I have the, all right, that was the check. That was the check. Now there is the check was correctly, okay, good. The bank statement also included a credit memo for interest earned in the amount of $35. I need to add this. Add $35. 10,083. And a monthly service charge of $50 minus $50. 10,033. 10,033. That's all I have. 10,033. Am I off somewhere? What's going on? 10,033. What's going on? June 30th, the company's cash balance was $10,012 before adjustment. Well, it's ending. Check number issued June. Wait. All right. June 30th. June 30th. Cash balance was $10,012 before adjustment. Well, its ending bank balance check number was issued June 2nd in the amount of $95. You're recording. Okay. Well, should I do something with the check or what? This is. All right. Okay. Let me find some help for this because we can't waste time. Wow. At June 30th, the company's cash balance was $10,012 before adjustments, while its ending bank statement balance was $10,772. Check number 101 was issued June 2nd in the amount of $95, but was erroneously recorded in the company's general ledger balance as $59. The check was correctly listed in the bank statement at $95. The bank statement also included a credit memo for interest earned in the amount of $35 and a debit memo for monthly service charges in the amount of $50. What was the company's adjusted cash balance at June 30th? Let me see what am I missing? I shouldn't be missing anything here. 26. What? Time goes by so fast. Check recorded incorrectly. Actual check $95. $59, that's $36. The company deducted only $59 but should have deducted $95. Oh, I added the minus 36. I should not add that. It's minus 36. It was a check. Okay. Minus 36 plus 35 minus 50. Okay, 9,961. 9,961. So, what happened? Check number was issued, or I issued a check for $95. So 10,000 minus 36. Okay, that was the only problem here. But even though I issued the check for $95, the bank received the check, but I recorded it at $59. So the only thing I need to adjust is the $36. Instead of minus 95, it's minus 36. And that was the problem. Okay. That was the problem. Let's go. That was the problem. Okay. Oof. I think I'm going to complete. Okay, I need to stop. So, these two questions. I have two more questions to do. All right, I need to stop. Yeah. Okay. All right. Thank you very much for sticking around. We're gonna have to have a hard stop right now. See you tomorrow. Okay.
Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, 365 over accounts receivable turnover. Day sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365.